If you're running a startup and you need capital, you probably already know how hard it is to get a straight answer on what's actually available to you. According to Bank of America's business owner research, 71% of small business owners plan to seek funding a year in advance. And the number one choice they turn to, business credit cards. Not a loan, not investors, credit. In this video, I'm going to break down every real option a startup has, what each one actually requires, and which one gives you the most capital with the least friction when getting started. Option 1, bootstrapping and personal savings. This is where most people start. How much do I have saved? What do I have available to me? And there's pros to this. You don't owe anybody anything. It's all you 100%. But the problem is that you're capped and you're using all of your own money and it can be limited. What happens when you run out? What happens when you need more? Do you tap into your personal savings? Do you put your family at jeopardy, at risk? These are all things to consider when funding your own startup. A good answer is to keep your full-time job while you're building your business until you can no longer do so, if that's an option to you. In my opinion, the biggest risk to self-funding your own startup is you're limited on resources and your limited runway. This takes extremely long to scale. You're waiting from your next paycheck from your job. You're trying to put together as much money as possible to pay for marketing, to pay for ads, to pay for a retail space, to order a new product, whatever it is, the type of business you're doing, from real estate to retail, to online, to e-commerce, to marketing, to service-based. It's all coming from your own pocket and it can take a really long time to scale. Not impossible. Some of the biggest businesses today bootstrapped the entire way. However, there are better options. Option 2, friends and family. It's a real option, but a dangerous one. You still retain all the control, but now you're putting your personal relationships at risk. It can make Thanksgiving and Christmas highly awkward when they're asking, how's the business? How are we looking? How's everything going? These people are going to highly scrutinize every purchase you make. If they see you out at a restaurant or somewhere or eating or doing something or even on a vacation or buying something for yourself or for your family, they're instinctively wondering, why are you buying that instead of paying me back? And God forbid the business doesn't work out, you just lost all their money and they're not going to be happy and you really should still pay them back. So now you're going to be working to pay them back in the long run. And on the flip side, if it does work out, they may want even more back than what was originally talked about. They're going to feel entitlement to the business and to your success. Option 3, SBA Micro Loans. These are designed for new business owners up to $50,000 and up to a 6-year repayment plan. Typically, these are a little bit lower interest and a little bit easier to get than your standard business term loan. The problem is $50,000 may not be enough, and there's a lot of requirements and restrictions on what you can actually use the money for. As well as the approval process, I've seen take up to 3 months and in some cases even longer. And sometimes you find out you're not approved. It is restricted on the type of business you're doing. So this isn't for every business. You'll want to look up the SBA qualifications to see if your business could qualify. Option 4, traditional business term loans and business lines of credit. This is what most people start off at and go looking for, and this is typically where they hit a wall. Most business bank term loans and lines of credit require 2 years in business and 2 years of positive tax returns. Emphasis on positive tax returns, which is hard to do because most business owners, even if they are profitable in the first year or two, we write everything off. That's one of the benefits and beauties of being a business owner is you have access to a lot more tax benefits and write-offs, especially in the first 5 years. However, if you are writing off majority or even more than you say you make, that instantly disqualifies you for business bank loans, term loans, business lines of credit, anything like that. However, if you do show profit and you are more than 2 years in business, maybe a little bit further along down the road, then you could qualify for a business line of credit and a business term loan. And there's a few banks out there that have low doc requirements where you can just show the last few months of bank statements to get qualified. This is something that we do for our clients. Option 5, venture capital and angel investors. This is a highly specific category of types of businesses and startups. Investors will review your business plan, run due diligence on your marketing team, market, and financials. And if they move forward, you negotiate terms and give up a stake in your startup. This makes sense for a specific high growth startup. Often in the technology field like AI or certain medical startups typically go down this path. But for most business owners, this path doesn't make the most sense and you give up sometimes a large portion of your business. Option 6, 0% interest business credit cards. This is the one that most people haven't heard of, and it's the one that changes the math completely. Business credit cards allow you to leverage your personal credit history and gain access to high limit business credit cards that have a 0% intro term, typically for the first 12 months. And if this is done correctly, you don't just get one low limit card when you open your business account, you get multiple high limit business credit cards all at the same time. This is called business credit stacking. This is multiple banks all applied to in the right order at the right time with all the correct data points on the applications. When done correctly, you walk away with, on average, anywhere from $50 to $150, sometimes over $200,000, all at 0% interest available on business credit. This is no docs, no tax returns, and no bank statements, all leveraging your personal credit history. This is the one type of funding that the banks are basing this primarily on you, not on your business history. They're going to take into consideration your personal credit score, your available personal credit card limits, as well as your credit card history, and most importantly, your utilization. If that's all in good shape or can be made to be in good shape, they will fund you even with a brand new LLC. Imagine what that 12 months of 0% interest and over 6 figures in funding can do for your business and your brand new startup. You're not paying interest while you're trying to figure out how to deploy the capital, what to invest in, while you're trying to figure out all the movement that you're going to be doing in your business. You don't have to worry about those high interest payments. You still do make a payment, but it's only 1% of what you use, not the total amount of funding. And you have a full year to put it to work and pay it back. And at the end of that year, the money's not gone. You still have access to all that capital, and you could have even gotten credit limit increases during the year, but you will have interest payments starting only on what you owe after that 12-month cycle. On top of just having the capital to use and deploy into your business, you also gain travel points, you get cash back rewards, and several other incentives that you would typically get with personal credit cards. But these are business, so those rewards are even higher. They have a higher multiple. So while you're spending in your business, getting things started up, covering all the beginning costs, you're also building points and rewards that you can use to treat yourself later on travel or even take advantage of the cashback rewards. Over the last few years, we've helped businesses in real estate, fix and flip, Airbnb, med spas, retail, online e-commerce, high-ticket sales organizations, coaching programs, service-based businesses, and they all take advantage of this type of funding. It can oftentimes be paired with other types of funding, other loans and lines of credit if you qualify, even SBA, but it's always good to have business credit for your business regardless of the type of business that you are. Real estate fix and flippers, they pair this with a hard money lender. Hard money lender buys the home, they leverage the business credit to do all the repairs and renovations, they sell the home, pay everything back, do it again. Airbnb, even Airbnb arbitrage. You rent a property, you list it on Airbnb, you leverage the business credit to furnish the entire property. It's renting, you pay it back with the rent over the year, rinse and repeat, keep doing it multiple times. Retail, build out is required. They leverage the business credit for certain build out. We've had barbers. They need to furnish with chairs and desks and workstations. Some brick and mortar locations like restaurants, they need equipment, they need cooking, they need food. Coffee shops, supplies, all of these things are covered with business credit. Most vendors take credit cards. Most licensed contractors take credit cards. Even if there is a 3 or 4% fee that they're going to charge to pay with the credit card, you're still not paying the 17, 18, 24% interest on a credit card that you would be because it's 0%, so it makes it worth it. We've had med spas. We've had pharmacies that want to order in bulk to get a better discount. We get them $100,000, $200,000 in 0% business credit. They can make a bulk order. They flip the inventory in 3 to 4 months for 4 to 6 to 12 times return, pay the initial card back, do it again, highly profitable. And the list goes on because every business is unique and different in their own way. Marketing expenses, running ads, media, whatever it is, there's a place for business credit, and it's some of the best working capital for startup businesses, even businesses within the first 10 years. Heck, we even have businesses that are 30 years old that take advantage of these business credit cards because they have something specific that they're trying to do. They use the cards, they leverage them, they make money on the money. Regardless of your business and your strategy, have a plan on what to use the capital for so you're not stuck at the end of the year with $100,000 on credit cards and no way to pay it back. Proper planning prevents this mistake. If you'd like to see if you qualify for any of these options, we have a free pre-approval process. Just click the link below to book a call with myself or my team.